9 o'clock Mountain Time right now. And we appreciate everybody joining us today. This is being recorded, by the way. So for those of you who would like to listen to this again later, it's certainly going to be available to you. It'll also be something that we can get out to other people that couldn't make it today. Clearly, there's a lot of people that have other stuff going on. They might be in a meeting or they might be at work or something like that. So we do want to make sure that this is very available to other folks. The reason why we're doing this today, by the way, is it's kind of we're just calling it a Q&A, but it's almost like an update in a way to the forecast presentation, just because there is a lot that's changed. Sometimes we do some stuff in between. Normally we do 2 economic market presentations per year that kind of look at everything. And that would be the forecast presentation. We do that. Usually we'll find a place, find a physical location, at least in Colorado, and then we'll do it online as well. We'll have a virtual way to do that as well. But then we'll do the halftime presentation. But invariably, sometimes there's a bunch of stuff that happens in between, and it may rise to the occasion where it just makes sense for us to jump on again and answer any questions that you've got. And that really is the focal point today, is you asking questions and just hearing our thoughts. And we're getting a lot of questions from clients, clearly, just in our normal client meetings. We always have review meetings going on. We always have people just kind of calling in and asking questions throughout the year. So that makes it fun for us, because that means every day we show up to work and we don't know exactly what's going to happen. It's a little bit different based off of people's lives and maybe other people's questions and concerns. But yeah, as Jeremy mentioned before, as we were getting set up, definitely want to make sure that you locate, because it's going to be the focal point of today for those of you who are attending live anyway, is that you have the ability to ask questions. And that would be the Q&A feature and the chat feature. Make sure you locate those on the screen. I don't know if you're better at describing that, Jeremy, the navigation.
Yeah, absolutely. If you just hover your mouse around the bottom of the screen, you'll see a little Q&A box pop up. That is the one that you want to use, and we will take those as they come in.
All right, good deal. We'll let people continue to pop in here, both on Facebook and in the queue as well here on Zoom. But it's neat that we get to do this. And really these days, we've got clients all over the country, not just because we have people that find us outside of this area in Colorado, but also because people's lives change, of course. A lot of people are traveling this time of year, got a lot of snowbirds, clearly, that are in other places that are warmer than Colorado right now. So we always want to make sure that things like this are available to you virtually, as well as when we have some in-person stuff. That can be fun as well. But a couple of weeks ago, I actually had the opportunity to attend Tony Robbins' Platinum Finance Conference out in Florida. And I've gotten to go to it several times now over the years. And it's pretty neat because they actually pull in some of the biggest speakers. Ray Dalio manages the biggest hedge fund in the world. Paul Tudor Jones, one of the top traders in the world. They'll pull in a number of people like that. And we get to hear a bunch of different perspectives over the course of 5 days. Some of them will completely contradict each other, which is great because it's good to just hear different opinions. I think the key on it is that you can get people with all the expertise, all the information, the top economists. Larry Summers was another speaker. He's been a Treasury Secretary under a couple of presidents now. So you can pull in the people that have the most experience, that have seemingly all the information. And if they're honest, they'll even say, we don't know exactly what's going to happen. So if those of you out there who are feeling a little bit anxious, uncertain about the world right now, you're not alone. Even the people that supposedly are the experts really don't know either. So hopefully that's a little bit comforting to you, at least, that we are all in the same boat. Yeah, that's just part of life and business, is that we don't know exactly what's going to happen. And sometimes we'll get some major curveballs, like we certainly have geopolitically with Ukraine and Russia over the last few weeks. But that being said, there's a lot that's also has not changed really since the forecast presentation. We talked a lot about inflation. We talked about the Fed, and to a large degree, the Federal Reserve does control the economy. It's a relatively small number of people that sit on the Federal Reserve Board. They're appointed, not elected. And, we could have a debate about that, whether that's good or not. But bottom line is they have an awful lot of control over the economy. And there's been a 180, certainly. And even that week that I was at the conference, there was a big 180 with our Fed chairman, in that last year you might have remembered seeing in the news and the financial news that they kept saying that inflation is transitory. Inflation is transitory, meaning that, hey, it's not something that's going to last over the long run. This is going to go away. Clearly, that has not happened. In fact, it's just accelerated. And in fact, at the same conference that I attended last year, they were actually talking about modern monetary theory, which basically is a theory that the government can print as much money as they want to, and there's no consequence to it. In other words, that it doesn't really have any negative downside. Clearly, we're seeing that that's not the case right now, because largely it is the Federal Reserve and their printing of trillions of dollars up until this point of money, put that much money into the system. And of course, inflation just comes from too many dollars chasing too few goods. That's what we're seeing right now. And in fact, I think a lot of you probably have seen that, just personal examples, right, of trying to buy stuff, trying to go buy a vehicle, trying to even go on vacation or go out to eat. Yesterday, I ran over to get breakfast burritos at Qdoba, and the dining room was shut. They had to lock the doors because they didn't have enough employees to open. And so you had to order on the app and wait until somebody brings a bag out to you, that sort of thing. So just a really weird time that we're in right now. And there's a lot of shortages, really. There's a lot of shortages of people, though there's a lot of shortages of products or the things that go into products. So certainly there's a lot of money flying around out there right now, and that's what's causing inflation. And I think that's going to be with us for some time. And that was definitely the consensus among the experts, is that inflation is not transitory by any means, and it is going to be going away. That being said, the Federal Reserve and the chairman did actually do a 180. And up until that point, continued to say that inflation was transitory. They were going to be very easy with monetary policy. And what ended up happening is that he got reappointed. Jerome Powell, the Fed chairman, got reappointed for an additional 4 years. Kind of interesting in that after he was reappointed and his job was safe for another 4 years, he did a 180 and basically said that they're going to be very tough on inflation now and start raising interest rates. Over the last couple of days, I think we've seen that their first raise of interest rates that we haven't seen since a couple of years, right? We've been at 0% interest rates since the pandemic began. And now we're at 0.25%, right? We've been at zero, now we're at 0.25%. There was a large consensus up until the Ukraine thing that there was going to be a 50 basis point or 0.5% increase in interest rates, somewhere even saying 0.75%, because really the Fed is behind at this point. They really should have been raising interest rates last year. They should have started. But again, somebody wanted to protect his job. Whether that's good or bad, we could debate about that, but it's pretty obvious that that change occurred with him being safe for another 4 years. So that being said, interest rates went up 0.25%. There's likely to be a number of different interest rate increases that come up over this year. And inflation is not likely to go away anytime soon. What we're seeing right now is probably something we're going to have to live with for quite some time. But certainly the Federal Reserve is a big factor in all of this. They caused the problem, really, at the beginning. They caused the problem by printing way too much money. Maybe some of it was necessary really to stave off a depression or just a massive economic collapse when everything shut down back in March, April of 2020. So it's possible maybe some of it was necessary, but it was too much. Basically, too much money was printed. At this point, modern monetary theory has been disproved as far as not having any downside consequence. And now they're going back and trying to clean that up. It's going to be painful. Some of it's certainly going to be painful because we'll be living with inflation for some time here. But also when the Fed starts raising interest rates, it's not without consequence on the downside. Partly what they're trying to do is they're actually trying to slow down the economy. And almost always, if you go back to other cycles, almost always we end up in a recession, and sometimes a really bad recession, actually, like we saw in the early 80s. The Fed had raised interest rates, been very aggressive on interest rates, and that is who the Fed chairman is actually modeling himself now, saying that we're going to be aggressive like they were back then. That means that most certainly we are going to see a recession over the next couple of years. Whether that's minor, if they get it just right, and oftentimes they don't, but if they get it just right, it's possible that the economy slows, inflation slows, and that we don't see a big negative consequence from it. But it's also possible that they go too heavy, that they increase interest rates too much. It causes a bad recession, and bad recessions don't necessarily have to last a long time. It could be that it's just a few quarters or maybe a year. And things kind of get cleaned up. That's one of the benefits of going through a recession, is it's kind of like being in wintertime. When you get into wintertime, things hibernate, things die. things regrow in the spring. And right now, I think it would be hard to argue that we're not in economic winter right now. We have been here for quite some time. But really, if you look at the next couple of years, they're likely to be a little bit tough, likely to be more volatility like we've seen over the last few weeks. It's likely that the Fed is going to get aggressive on raising interest rates. Inflation will continue. And we can certainly talk a little bit more later as far as the implications for the market and different asset classes. But I think that's kind of what we've been thinking right now over the last few weeks since I was at the conference. And as we're hearing the same news that you are, that's what I've been kind of thinking the last few weeks. So with that, Jeremy, I don't know if you want to chime in on any of that, just kind of as an intro, and then any questions that have come up so far.
Yeah, no questions as of yet, Josh. But yeah, the interesting thing that we can kind of keep an eye on, and that we do, is like you were saying, the Fed and their rate of bumping up interest rates. So I think you're right. I think what's happening in Ukraine definitely impacted the Fed decision. A lot of people were thinking that a half point bump was going to do it. Really, though, I think that weighed in. On the bright side, the market really liked the fact that it was only 25 bips that they went up. And so last week, you can kind of see how the market takes a little while to digest it. It's actually kind of a bit of a social experiment, right? Anytime the Fed says something, we can kind of watch what happens in the market, see how it gets digested. But to kind of keep it all in perspective, really, when we look at the overall market, it is still fairly strong. Company earnings are fairly strong. People are still spending money, and the fact that 70% of our economy is us spending money, that's a pretty big factor in this. And so really, it's going to come down to the fact where either inflation takes over or interest rates take over, where it just gets too expensive for people like you and me to spend money out there, which is really going to kind of turn the tide on this. But we'll see how long that takes. But I agree with Josh. We should probably buckle in for the longer term on this one. Who knows how long at quarter point interest rates, how long that's going to take to kind of rein it in.
Yeah, it's a good point too, because it's not instantaneous. It's not like the Fed raises rates and boom, it slows the economy. It actually takes some time for that to really get absorbed in. So oftentimes you could be through an interest rate raising cycle like we saw back in the late 70s or late 90s. You could be in it for quite some time really before it has the intended impact and pulls back inflation. And maybe that's actually a good segue too to one question that I know comes up a lot is, what is inflation, and is it good? Is it bad? Well, deflation is the opposite of inflation. You definitely don't want that, because that means your economy is actually going backwards. And that's what we saw. Really, the only time of severe deflation or of any length of deflation was back in the 1930s during the Great Depression. So I don't think we're in any danger of that right now. But that one also was largely caused by the government and missteps by the Federal Reserve back then, as far as why the Depression was so severe, why it lasted so long. Certainly, it was created by some excesses of the 1920s. So for those of you who are students of history, probably even better students than Jeremy and I, but certainly there were some times back then that were much, much tougher than right now. You always want some inflation. And for those of you who have seen, we have a big chart in our office. You probably have seen it before, where it shows the stock market and the bond market. And it has a lot of data points in there as far as it has some red and blue bars as far as who is in charge of the presidency and the Senate and the House. So it's pretty nice because you can kind of see all the data points overlaid together. And really, I think it tells a good story. Over the last 100 years or so, tells a good story as far as where we've been, maybe what was happening. In other words, you could kind of look at that chart without understanding any of the history and kind of understand what was going on, what probably caused certain things to happen. So I think that's been a good tool that we've been able to use with clients. There's a lot of them you can just Google images. You can pull up things like that, but certainly we like to use that with clients. Steady state inflation over the last 100 years or so, Jeremy, it's about 3. Is that what the last chart shows?
Yeah, over the last 100 years, the average is about 3%. I think we're feeling this a little bit tougher because honestly, over the last 10 years, it's actually been closer to about 2 or 2.1%. So that kind of throws a little stark comparison pretty quick, like in our faces.
Yeah, so 3% inflation, that's kind of steady state inflation. And if you think about what inflation really is it's a loss of purchasing power. Basically means that if you had money, just money in your pocket or money buried in your backyard, the purchasing power of that money has lost on average about 3% a year, meaning that you've got to have more of those same dollars to be able to buy the same stuff. And like Jeremy said, we've been experiencing really, really low inflation over the last 10, even 20 years. It's been relatively low. And so now the spike in inflation, which is 3 or 4 times what we're used to, it feels really bad. And in certain things like food, you could point to certain things that are kind of in our face, right? Every week we're buying them, like gas and food, utilities, things like that. People are seeing these big spikes. So it gets kind of in our face and we're wondering, all of a sudden, what is inflation? How is it going to impact me? Most of the time, we don't even think about inflation. It's just so light and so gradual that it just kind of creeps up on us over time. But that's the point of investing in the first place, is that if we did just bury our cash in the backyard or even put it in the bank. Right now you're earning 0 in the bank right now too, pretty much. But if you keep just cash and hold on to it long term, that's going to gradually lose value. And right now it's losing a lot of value, depending on whose numbers that you believe, right? There's all kinds of different inflation figures that get thrown out there. We're seeing 7, 8, some are saying, no, it's actually probably more in the teens. It's probably more like 10% plus. But it also depends on what it is that you're looking at and what you're buying, what package of goods and services you're buying. This is actually impacted. They're saying this is actually impacting lower income people more than it is for a lot of other folks, because it's those basic things that everybody has to have: utilities, food, gas, and in a lot of cases, fuel expenses, gas expenses. Oftentimes people that are lower income have to live further away from wherever their workplace is. And so it's disproportionately affecting them. So
Absolutely.
yeah, so
Yeah,
3% on average.
Yep. And we actually got a really good question here.
Yeah, good.
How does printed money enter the economy, right? It's not just Bill in the back shed printing off 20s, right? It's how does that happen? And kind of how do, bond rates, interest rates, how does all of that stuff kind of equal into the mix? How does it all get affected together?
Sure. Yeah. And I'm not an expert on monetary policy, so I'm sure I won't do as good a service as some might. But yeah, basically the way that we used to have dollars enter the economy was that they were printed. Right now, I think a lot of questions are coming up, right? Digital money, digital currency. Well, to a large extent, we've already been there for a while. Cryptocurrency is a new phenomenon, but really, as far as us having digital money, pretty much that's how, at least personally, I haven't spent a lot of paper money for years. I mean, well before the pandemic, well before, Bitcoin even came out or any of these things. So to a large extent, the money that we see in our bank accounts, it is the banks that money flows through, and it's almost all in computer code, right? It's out there on the internet. So it's kind of mind bending a little bit. You start to think about money and what is it? The reason why the dollar still is the predominant currency in the world right now, it is anyway, is that it's the most trusted, it's the most used, it's the largest. Certainly we're the largest economy in the world, and because it's backed up by the full faith and credit, and I know some people will chuckle, right, with our $30 trillion of debt, but the full faith and credit of the United States is what backs that up. More or less, though, it's us believing that money is going to buy something, and businesses, of course, most of which are small businesses. Of course, we've got big companies like Coke, Walmart, and so forth, but a lot of money flows through small businesses as well. Those price points get set based off of supply and demand, what people will pay, in other words. So if you're seeing prices go up, well, it's because somebody's willing to pay it. Somebody's got the money, is willing to pay it. And if somebody has too much stuff in their store, too much inventory, they're going to lower those prices. So when you look at a collection of goods and services across the economy, really it's that equilibrium of supply and demand, back to probably high school economics class, right? But it's a little bit mind bending in the sense that because those dollars used to be physical dollars, we used to be able to see them. Now we really all, I think, have adapted to using debit cards and credit cards and doing Venmo and electronic transfers, those sorts of things. The new phenomenon of digital currency is another element there that we probably won't get into as much today, but certainly that's not going away. That's going to have a bigger and bigger impact.
Yep.
overall. And
Yeah,
certainly seeing that in the news too, like Ukraine, they're saying that actually most of the money that's being poured into Ukraine right now, as far as donations, is actually coming in the form of cryptocurrency, digital currency.
yeah. And in terms of, modern day, how money gets printed, it is largely through the banks, right? And just like we were kind of going back to the original point of the economy as we see it is 70% made up of what you and I spend, right? So how are we spending? Well, when the Fed lowers interest rates and buys bonds and T-bills and things from banks, that allows banks to basically lend more money cheaper to people like you and I, to companies as well, corporations. That puts more money out there for more people to spend, right? And right now the inverse is happening. So the Fed is, letting all these bonds and T-bills that it bought from these banks during 2020 and 2021, it's letting them fall off of their balance sheet. So that kind of tightens up how much money the banks have to loan out. And then they're raising interest rates, which make it a little bit more expensive for banks to both loan money out to people and loan money, from other banks. So that's kind of how it really works, is controlling the ebb and flow of money to and from banks, which ultimately kind of goes to and from people like you and I. It's, yeah, pretty crazy stuff. We have another good one here, Josh.
Sure.
With Fed's upcoming interest rate rises, do you see a return to bonds near term or longer term, or will bond alternatives continue to balance equities in kind of the portfolio mix?
Yeah, so it's the kind of the holy grail. This is from Ray Dalio, again, who manages the largest hedge fund in the world. Pretty prolific out there. If you can pull him up on YouTube, see a lot of his commentary and things. He's kind of at the stage of his career, his life at this point, where basically he's doing a lot of giving back, a lot of teaching, things like that. And then I think he's probably not too far off. Within the last few years, he's probably planning on kind of pulling back and retiring. So kind of an interesting perspective, knowing that the amount of time, decades of experience managing money and seeing economic cycles. But the holy grail that he said is basically 15 uncorrelated asset classes that will reduce your risk by 80%. So I thought that was an interesting concept that he had talked about. And when we're designing portfolios, really what we're trying to do is figure out what their risk tolerance is. That's the jargon that we use in our financial industry. But risk tolerance basically means how much turbulence can you accept. We were just on a Disney cruise this last week, just got back on Saturday. And invariably, that's one of the parts of being on a ship, certainly, as you're going to get it going back and forth and you take your Dramamine and all that, right? But, to get there, you're going to be on a plane and there's always turbulence. It doesn't matter where you're flying, how the weather is, there's always going to be some turbulence, especially when you land in Denver, almost a certainty that's going to be there. So that's really our job as financial planners, is to spend time with our clients and really figure out what their risk tolerance is, what their turbulence tolerance is, right? As far as what they can, still sleep at night at. Because right now, let's say that somebody had zero risk tolerance and all their money was buried in the backyard, saying in the bank. That's a tough place to be right now when you've got inflation running at 7, 8, 9, 10%, again, whatever figures you want to look at, and your bank account's basically earning zero, really close to zero anyway. That means that you're actually losing 7, 8, 9, 10% per year. Just as a matter of inflation. Normally, again, that number has been 2, 3%, so it hasn't seemed so painful in the past, but losing that much money per year, really, really tough. So the reason why anybody invests in anything is because they want to try to get a return. They expect some either current return or future return on those investments. So kind of looking at other asset classes that tend to do well in inflationary environments, they tend to be stocks, real estate, sometimes gold, newer phenomenon with digital currency, and there's a mixed bag there, right? Some were actually thinking that Bitcoin would be a good inflation hedge. So far hasn't been. Maybe it will be long-term, but we haven't seen that come into play as of yet. But real estate and stocks tend to be the best. And the reason why basically is that if you figure if you went out and bought a piece of real estate right now, say you bought a rental property, well, what ends up happening is your costs go up over time as you have the ability to raise your rent. And so that's part of the deal, right? Is that you get an increase in cash flow over time, and you hope your property goes up in value as well. So that works on a large scale as well. If you owned big apartment buildings or big resorts or whatever kind of real estate that you've got, you expect an income and some appreciation off of that. With stocks, of course, companies, businesses, including Keystone, we have the ability to change prices. Say if I owned a shop and we had say I owned a car dealership and we had a limited number of cars, as they all do right now. If you drive by any car dealership, not very many cars out on the lot, yeah, you have some pricing power, right? Because there's a lot of people who want vehicles. It's about the only time I think in history where used vehicles have actually been going up in value the last year or two. So going back to fixed income then is kind of the other main asset class. And there's lots of different types of fixed income. Corporate bonds, which are issued by companies, government bonds, which are issued by the government, municipal bonds, which are issued by state and local governments. So there's lots of different types of bonds, and different types of bonds will behave differently depending on the economic cycle that you're in. So bonds in general, if we kind of lump them into a big category, which probably isn't fair, but we will just for the sake of the question, is that bonds will tend to do poorly in an inflationary environment. And the reason why is because that inflation is probably eating away at the purchasing power. You're probably not earning enough yield on your bond to really overtake whatever inflation is. But also when the Fed starts raising interest rates, what can happen, it often happens, is that certain bonds will actually lose value. They'll actually lose value because what ends up happening is that, say if you went out and bought a 20-year bond right now, let's just make one up. Let's say we'll pick a really, what we think is a safe company, maybe Walmart, right? So maybe you buy a 20-year Walmart bond and it's paying 1.5%. And it's probably about what you would get too, right now if you went out and did that. And you say, well, that's kind of crazy. Why would you lock your money up for 20 years for 1.5%? But well, I think it's safe. And so I'm just going to do it anyway. So somebody goes out and buys that bond. Well, let's say that interest rates get increased. Maybe over this cycle, we see 6, 7, 8% or 6, 7, 8 interest rate increases over the next, say, 12 to 18 months. I think that's pretty likely. Well, now new Walmart bonds that you could buy, say, 18 months from right now, maybe you can get a 3% or 4% Walmart bond. Maybe it's up at that level. Well, now let's say that you haven't waited your 20 years, but you want your money back. And Walmart says, no, that wasn't the deal. We said that we would give you your money back after 20 years. So your principal is locked up. Well, there's a secondary market out there for bonds. And so if you wanted to go out and sell your bond, there certainly would be a buyer out there. But if you had, say, paid $1,000 to put your money into that bond, nobody wants your bond anymore. The interest rate's terrible, right, compared to what they could get if they went out and bought a new one. So of course they would be willing to give you some money, but they're not going to give you your $1,000. It'll be something less than that. So obviously the bond market is a massive, multi-trillion-dollar market. So when you look at the overall bond market, it basically works like that. All the individual securities that go into that, interest rate increases can actually diminish the value of those bonds. What we've seen in other interest rate cycles, and this is where, if you're looking at your portfolio and you've seen some of the moves that we may have made in the portfolio, what we're trying to do is we're trying to keep some fixed income assets in there, because just throwing out fixed income and not having any bonds in the portfolio or any cash, any, kind of safe investments, most people are not going to have the risk tolerance for that. Most people don't have the risk tolerance to have all their money in stocks and real estate. Now, over the long run, are those the asset classes that have done the best over time, and certainly in inflationary environments? Yeah, they have, but most people don't have the stomach for that. So, as pilots, it's our job then to, we could get there faster if we just went through the thunderstorm, but we're not going to, because it's going to make everybody lose their lunch, right? And so, we're going to try to, change altitude and go around the thunderstorms and get there a little bit later. And that's effectively what you're doing if you're accepting a lower risk tolerance, including bonds, things like that in your portfolio. You're just accepting that it's going to take me longer to get there. I'm just not going to get as much of a return over time as I would otherwise, but it's going to be a lot smoother ride. And a lot of people, they'd say, that's great. I'm fine with that. I'm fine with a smoother ride. But, if I don't have the craziness that an all stock, all real estate portfolio would have. So overall, I think that kind of speaks to the question, but overall, bonds are not something to completely throw out. I think for a lot of people, it's just that it definitely is going to be important to look at the kinds of bonds you have in your portfolio, and not all bonds are created equal. Like I mentioned at the beginning there, long-term government bonds actually don't tend to do too terribly in interest rate increasing cycles. In fact, they tend to hold their value fairly well. Shorter term bonds actually end up getting hit a little bit more, or intermediate term bonds. So that's why we have to be a little bit selective. We just need to be careful of what's in there. Of course, there are other bonds that actually do well. And you probably have seen some of this in your portfolios. If you see something that's invested in TIPS, which are Treasury inflation protected securities, TIPS actually do well in an inflationary environment because the interest rate is actually tied to inflation. So those actually can do really well and are doing very well right now. So I think it's important to just note that it's probably an asset class you're going to have in your portfolio, whether you like it or not, but it's going to depend on where we are in the economic cycle. And certainly we watch that, and the research that we look at from big institutions, certainly they know that as well, as far as where we are in the cycle and what securities are expected to do better, at least maybe not do as bad. I think in a lot of cases, that's kind of what you're looking at when you're holding bonds.
Yeah, and you actually kind of inadvertently answered the next question too on that one is, what are we doing? What have we been doing to modify our personal accounts to maximize financial security? And I'll just kind of tack onto that is,
Sure.
honestly, it's not something that we've just started doing. I would say easily, over the past year and a half, we use a lot of different research out there. We use Fidelity, TDA, BlackRock, a lot of companies that have huge research commitments to the financial markets, right? And so in doing that, we've actually been making small moves over quite a long period now, just like Josh was saying, kind of choosing those a little bit better bonds, like increasing the amount of TIPS bonds that you have, knowing that interest rates were going to be increasing. We just didn't know when exactly. The other part too is a lot of you will see shifts in big portions of your portfolios that have been moving towards commodities, actually kind of maybe out of some of those maybe shorter term, intermediate term bond funds into things like commodities or real estate. And so some of that's done on a very general manner. Some of it's done very specifically, with specific clients in mind. It just depends on a lot of what your risk tolerance is on that, how it all fits together, and how we can maintain a good portfolio within that risk tolerance and still kind of, safeguard certain parts based off of a lot of research that we have been doing.
Yeah, I think that speaks to a lot of people's portfolios. When you go in, if you log into your account and really go through and look at what you own, you will see that there are a lot of different asset classes. Certainly our clients are always going to have multiple asset classes. We're never going to recommend that everybody put all their money in tech stocks or put it all in Bitcoin or one thing. Eventually that's going to be financial suicide for you if you try to do them. And I know some of you have seen other people. Hopefully you haven't had that happen yourself, but sometimes those temptations come up, and we saw that actually a little glimpse of it. I'm old enough to remember the late 90s, early 2000s, and some of you were clients back then too, and experienced the tech wreck, I think, with everybody else. But a lot of our clients, because we are focused on the tech sector, a lot of our clients did have some significant holdings in tech companies, and those as a category, you were down 70-80% at one point in that bear market that ended up following. Now, did a lot of those companies come back? Well, certainly. Did a lot of those companies go broke and never come back? Yep, that happened too. A lot of the dot-coms, right, that ended up existing at the time. So I think it's just important to be very diversified from an asset standpoint, have all these categories covered. We saw a little echo of it a couple of years ago where the returns were just coming from a select few companies, is what it kind of looked like. I remember the FANG stocks, the financial media called them the FANG stocks. Was it Facebook, Amazon,
Apple, Netflix, and Google.
Yeah. And so there was this movement to, hey, there's no reason to hold the whole stock market, have all these other areas covered. You can just put all your money back into tech stocks, put it all into these 5 tech stocks. Just financial suicide to be doing something like that. So you never want to get tempted out of asset allocation, simply because it's the best way, I think, to not get hurt over time, is to understand the risk that you've got.
Oh, Josh, I think we lost your audio there.
Test. 1, 2, 3.
Yeah. All of a sudden we lost your audio.
Am I back?
Go ahead. Actually, I have a question that just came up that I think I can handle while we can. Okay.
Jim says audio is fine for me. Can you hear me, Jeremy?
Actually, maybe it's not me. Go ahead. Maybe it's me.
Test. Yeah, Jim says I hear Josh. Thank you for communicating on that.
Yeah, I appreciate that.
Yeah, so all these asset classes, though, I just got to finish that thought. I think that's one thing that it sounds really boring when it comes to, asset allocation and having your portfolio diversified. It sounds really boring. And sometimes, especially if you're paying attention to a lot of financial media, they do make it sound like, hey, you should put all your money in this one area. You should put it all in cryptocurrency or something like that. And it's not to say that that's not legitimate. I mean, if you've got the stomach for it, cryptocurrency at this point, especially even the most solid one, probably is Bitcoin, you just see some massive volatility in those asset classes. So I think at this point, most people probably aren't up for that ride. But as Jeremy said, sometimes even injecting some, small levels of commodities, gold, things like that into portfolios. And some of you do hold those things. A lot of you hold those things. They can be nice diversifiers because they do act a little bit differently than the other asset classes.
Absolutely. So we got another one actually that actually kind of came up last week, to tell you the truth.
Yeah, good.
But I thought it was a really good question. With everything that's happening, Russia, Ukraine, and all the sanctions on Russia, the question was, how does that affect things kind of globally, right? And so we have to think about that in a couple different ways. If we think about just financially, Russia they only make up about 2% of the global economy, believe it or not, for such a big nation in the world. Only about 2% of the global economy. And in addition, its trade with the US amounts to less than 1% of our total imports and exports. And so then I know you heard, so that kind of, I think puts that into perspective. And then the other part is that someone had brought up was that there was a lot of talk in the media about Russia potentially defaulting on some of their debt, right? And so when we put that into perspective, there's about $20 billion of Russian debt that's held by foreigners. So largely in dollars and euros. Okay. And then about 40 billion of that is denominated in rubles. And so the stuff that was denominated in rubles is really the stuff that the media was talking about because of sanctions, rubles have, dropped really, really hard. But when we think about this on a daily basis, there are trillions and trillions of dollars that trade in debt markets of foreign debt around the world. So when we think about it, yeah, to you and I, we see numbers like 20 billion, 40 billion, and that's pretty big money, right? But when we look on the entire debt exposure of the world on a global economy scale, it's actually not as much as maybe you would think. So the risk of global financial shock just from sanctions and things that we would do to Russia is actually fairly minimal. Now, the one place that really does come about is more so in energy markets. And the reason is that when we look at just crude and refined oil, Russia totals about 7.5% of the total global supply, right? So yeah, that's a lot bigger deal, not necessarily, for Russia, but for the rest of the world when NATO countries come out and say, we are going to basically be stopping buying Russian crude, right? That's a lot bigger. And the part where that gets kind of painful is that yes, we can get oil from other places. We can increase production here within the United States. There are other countries out there, Arab countries, where we can get it from. That stuff doesn't happen overnight. It's like interest rate increases. Those don't get fixed overnight. Your supply chain of oil takes a little bit of time. And so what we'll see is, at least for a little while, increased prices just because of supply and demand. But the more that, we can come up with that from other places, yeah, it'll go. And it's already underway as far as ramping up. But again, just like inflation, that's one of those things that we should probably all buckle our seatbelts and say, this is more than likely going to be around for a while. So we're going to have to deal with that.
Yeah, there could be some real spikes this summer. That's what we're hearing, is that although, temporarily the price of oil has actually come down quite a bit. That's why you never want to bet on this stuff, by the way. For those of you who are thinking, well, this is a no-brainer, why wouldn't you put all your money in oil or something like that? You don't want to do that. But I think if you look at where the demand is typically the highest is in the summertime. I mean, and so oftentimes that is when we see a spike anyway. That is likely something we're going to see. If prices, stay high persistently, that's going to also kind of stoke inflation even more, and it could cause the Fed to have to get even more aggressive. And that was similar to what we saw back in the late 70s, is that we saw limited supply. Politically, we're not going to get into it as much as far as, the implications, because we could talk about that for a long time, but there's a lot of other people that are spending a lot of time talking about that. So we don't need to. But I think overall, it's disruptive of supply chains, energy included. Certainly raw materials, not just oil and natural gas, but because we've been in such a global economy, we've gotten used to this over the last few decades, where it's really a global economy. Even a seemingly small country or Kazakhstan or something like that, it could have a big implication, right? If supplies get shut off from that area, it could be very disruptive of trade. So the supply chain issues we've seen the last couple of years, from the shutdown in the global economy, restarting things, it's just kind of one more wrinkle that's been thrown into the mix. I think you are going to find a lot of players that get into the market again. So we've even heard that locally. There's a lot of people that have mineral rights in eastern Colorado that all of a sudden they had wells that were capped off. Now they're kind of jacking up their production because they can make a lot of money when oil's at this price. So that's one thing to keep in mind, is that whenever there's a commodity that has a huge spike in price like this, it is temporary, because ultimately the market does balance things out. There'll be a lot of people that get into the market and start producing more product, and eventually things will end up equaling out. That doesn't mean that it's not going to be painful in the near term, but I think overall it's something we're going to have to live with. It was a big wrinkle that got thrown into the mix here. I don't think anybody expected, that there would be a full-scale war going on in Ukraine. I don't think Putin thought that it would be this difficult either. It probably was a big political miscalculation that he made. He was probably thinking that he would be able to kind of come in, quickly, take things over, and it wouldn't be that painful for Russia. And certainly it's turned out to not be that way.
Yep. Yeah, absolutely. So honestly, no other questions. If you all have, I know we're kind of coming up on our time allotment here pretty quick, so we'll throw it out one more time. If you do have any questions that you'd like to ask today, just use that Q&A feature at the bottom of the screen. If you haven't found it already, Q&A, type it in and we will address that.
Yeah, while we're waiting for one too, one of the things that precipitated this too is just market volatility and so much uncertainty out there. I would go back to the fundamentals. Remember why you're invested the way you are. Remember that your portfolio was designed off of your risk, what kind of returns that we're trying to seek over time. So everybody has a little bit different portfolio and financial situation, but kind of going back to that original plan keeps you from being whipsawed by emotions and what's going on in the day-to-day. You have to remember that any kind of an asset, whether it's a stock or the stock market or Bitcoin or anything like that, because the market pretty much trades 24/7 these days, what that means is that anytime we get new information, especially if it's surprise information like an invasion, the market's going to be trying to price that in immediately. Market's trying to price in, what does this mean? What does this mean? That's what the market's always asking, is what does this mean? What does this mean for the future? And so that's what you see reflected in prices. And when you're seeing tons of volatility up and down, what that means is that we don't know. There's a lot of uncertainty. And so the market's guessing, right? And everybody's trying to figure it out. Once things become more certain, even if that certainty sometimes is maybe a negative thing, like a war or something like that, once kind of the reality sets in and people know what's going on, then you tend to see that volatility go down. Again, even if it's a bad certainty, at least everybody can kind of absorb that and know how to react going forward.
Yeah, and I would agree. That's the market tends to take some time on that too. It tries to always price it in and whatnot, and a lot of the times it guesses wrong. We see that through futures valuations and things of that nature, where all of a sudden, something happens in the world and the market's like, oh my gosh, this is going to be terrible. And then we have, one of our best days in the market. It takes some time to digest that and to actually kind of play out. So that just kind of adds to that daily volatility. So the more you look at it on a day-to-day basis, yeah, it's a roller coaster up and down. It's kind of important to have, more than ever, to have that longer term focus.
Yeah, absolutely. And just to kind of round things out here too, one of the overall themes, from the conference I was at, one of the overall themes was that everybody was for different reasons and different timings and asset classes and everything, but everybody was, fairly sober about the near term, that the next, not even just in the next couple of months, couple quarters, but over the next couple of years, I think we're in for a rough spot. We definitely are in for a tightening cycle for the Fed here, and hopefully there'll be some good surprises too along the way, right? Doesn't mean all doom and gloom, but I think we have a very different economic situation the next couple of years from what we've had the last couple. The other thing, though, is that everybody was long-term very optimistic as far as where things are going from a technology and innovation standpoint. We are looking at some really neat opportunities and growth that's going to happen over the next decade. So that doesn't mean that the story ends badly. In other words, the volatility and Fed and talk of recession, that doesn't mean that the end is bad. It just means that we're in for a little bit different, experience from what we've had. But staying disciplined through this time frame. Market timing never works consistently. There's never been anybody, Warren Buffett has said that he has never met anybody who can consistently time the market. And he's been in that business for 60 plus years at this point. So as tempting as it may be, just, stick to your plan and certainly reevaluate, if there's something that you are concerned about. We know you do, people reach out to us, but if you have concerns or questions, certainly reach out to us anytime you've got those. We also want to be here as a resource for any of your coworkers, family, friends. I think a huge part of the value, most of you on this call today are clients. Some of you are not. Thank you for joining us, by the way. But, there's a lot of people out there. I'd say that the vast majority of Americans don't really have anybody to talk to. When it comes to this stuff, they're just kind of scared. They're not sure what to do. And so then, either they do nothing, or sometimes they make some emotional decisions that don't end up working out very well financially. So a lot of people just don't have anybody to talk to. Point them to these resources. There's a lot of stuff that we do that's free, that's kind of open to your family and friends to join as well. Obviously, a lot of what we do, conversations with you and planning and so forth is exclusive to our clients, but we definitely want people to be, to just know we're here as a resource, know that we're here to be able to help people out. In some cases, we'd be able to point them to a resource, even if we're not maybe the best fit for them from a client standpoint. We definitely want to be the antidote to all the craziness that's out there, because there's plenty of craziness. So with that being said, I think I saw one more question and then we'll sign off.
Just a comment, actually, that, oh, that's very nice. Ken says, feel very good with Keystone managing assets and no need to worry day to day with all the crazy news.
Yeah,
So
we hear that a lot. We hear that a lot from clients,
that.
is that, we pay you guys so you guys can worry instead of us having to.
Absolutely.
Yeah. Well, thank you all. Yeah, definitely appreciate your time today. Thank you for signing on. And we'll do more of these. It may not be every week, but especially when things get more volatile, you kind of expect the captain to come on, right? And say, going through some thunderstorms, and here's kind of what we're doing about it, right?
Absolutely. Yes. Thank you to everybody for taking your time today. And if there's any additional questions after we go off, please email us. I believe you can find our emails on the website as well. Otherwise, it's just josh@keystonefinancial.com or jeremy@keystonefinancial.com, and we'll be happy to take those questions.
All right. Sounds good. Thanks, everyone. Have a great week.
Yep. Take care.
Yep.